Hello and welcome back to the ROI channel, the channel that is obsessed with all things to do with the art and science of return on investment. Got another stock review today, one of the holdings in the Crassus investment portfolio. And with the news making the weekend with the Australia, UK and US naval alliance in the South China Sea, it's very appropriate topic. So we're talking about Huntington Ingalls today, which is a very interesting defense stock. We're going to talk about more about that in a moment. Thank you to those who are already copying and following the portfolio on eToro. If you haven't already, click the link in the description, and you don't have to invest if you're not ready. You can just add it to a watch list and see how things go. Obviously, if you like my style of investment, you can just hit the copy button if you're good to go. And if you haven't already liked and subscribed to the YouTube channel, I would greatly appreciate that. That helps out a lot with the algorithm and helps me to get feedback as to what types of videos people would like to see. Without any further ado, the Crassus investment formula for companies that we're looking at are those with low debt, margin of safety, sales growth, strong margins, so EBITDA ideally outpacing the top line revenue growth, free cash flow growth, so after all the business's expenses and taxes have been paid, how much cash is left over to either be distributed to shareholders via dividends, to invest in other forms of growth, or share buybacks, and that's always a nice little kicker if we can get those. So Huntington Ingalls, let's have a look at the quick facts in the numbers, and then we'll talk about the qualitative key points as well. So revenue just shy of $10 billion US dollars expected to come in for 2021. We've got a dip thanks to COVID. 2022, we're expecting a massive kick in terms of the numbers. So we'll talk about that when we do our short-term estimates. EBITDA 850 US, and they've been able to maintain a slight margin expansion over the last few years, which is great. Market cap 7.82 billion, enterprise value 9.33 billion. And the share price took a dip today. Time of recording, the share price is $194.99 US dollars. Shares on issue 40 million. They engaged in a buyback program that reduced the shares on issue by about 1% of the total float. And you also get a dividend, okay? So you're being paid to wait for the company to compound those returns, which is always a nice thing. Return on capital, 23%. Very, very good, especially when you consider the type of capex that's involved with a naval vessel manufacturer, which is what Huntington Ingalls are. Net debt to EBITDA is fine, just to tick over 1 times, and so no problems with the balance sheet there. Here's the price action over the last year, okay, so calendar year, retrospective 365 days, and very healthy looking chart for Huntington Ingalls. They performed extremely well in this environment, and I think that they've got a lot more upside given the current state of geopolitics near where I live down in Australia, which is fast separating into a deteriorating state, let's say. In production and equipment involving military vehicles, unfortunately, may be a booming industry for years still to come. Key points. Huntington Ingalls, they design, build and do repairs on Navy vessels, mainly with the US government. They are involved in manufacturing of all sorts of different fleets, both nuclear powered and non-nuclear powered. So you would have seen in the news recently about Australia moving out of the dark ages finally and getting into nuclear power subs. And so Huntington has the ability to do those, although they are more focused in when it comes to nuclear powered vessels, aircraft carriers and assault mission vehicles, and so on and so forth. Obviously these things go out, Navy SEALs bust them up and they need repairs, so Huntington are involved in the ongoing contracts for the repairs and maintenance of said vehicles. As I've mentioned, it's a growing market due to tensions in the South China Sea, with the individuals in charge of the White House at the moment. Let's just say there's been a loss of confidence around the world in the old Allied States in terms of the US's ability to provide protection to the rest of the world. So they need to really up their game in terms of providing reassurance to countries like Japan, Taiwan, other nations, Australia, that are located close to the South China Sea. So if we continue to see tensions boil over, then there's going to be a need for more military patrols. They've already been regular patrols in the South China Sea, and I expect that to unfortunately escalate, which is a growing market for Huntington Ingalls, even though I would prefer to see things de-escalate from a military standpoint. Okay, projections looking out into 2022. So end year 2022, most of the CapEx will have been done, and we have some very, very juicy looking numbers. So currently, this looks to me like a business that the market doesn't really know how to price. And so you're finding that Lockheed Martin, which is another defense contractor, LH3 or L Harris Technologies, which is a company that we used to own. I've done a video on that. We sold at a nice little profit, and we're rolling those profits into Huntington Ingalls. They're trading well below the industry median multiples, as we'll see. So if we look at, if you follow my cursor to the expected free cash flow, EBITDA, and earnings per share, so EBITDA here is on a per share basis, and we apply just a tick under the median multiple for these businesses being conservative, these are the implied prices that the metrics would project. And so we're looking at potentially 65% upside in a quick turnaround. Now, if it were to happen that quickly, I would then start to, I would probably take a good chunk of the profits and the original investment out and look to roll it into another opportunity, which I don't normally do, but that's a long way to run so quickly. We'll see how it plays out. We'll be happy if we get there. It'd be a great problem to have for me to need to allocate all that extra capital. If we look on a longer term basis, and if we take into account different scenarios and different metrics, things look a little more subdued, and that's because I've smoothed things out in terms of growth rates over a 10-year period. It is a somewhat cyclical business. You can't just churn out a submarine or an aircraft carrier overnight. So you're going to have very much these long cycles where your lead orders will be placed, and you have a lag time in terms of the manufacturing of the equipment. And so taking into account the designing revenues and the repair revenues, they should tide the business over until they can complete on large vessel contracts and start to pump out as many of those bad boys as they can. So very conservative growth rates have been used for enterprise value method and free cash flow method and earnings, as we always do. And so what I have done is applied these probability weights to those scenarios, discounted them back today using our required rate of 20%. And so that gives us an average intrinsic value suggested at $252.32. Or in other words, if we want to hold this business for 10 years and exit at a median multiple value for our terminal value, and we need to pay no more than $252.32 per share, so that the share price is trading underneath that. If we do a straight IRR using the company's cost of capital, which is the way a lot of people like to do things, here's the EBITDA, okay, on a per share basis. So these would be the earnings before interest, tax, and depreciation, amortization at the expected growth rate, and then selling at the median multiple in 10 years time. If we pay the price of the shares today, the asking price, discounted at the cost of capital, that gives us an expected annualized return 17.6%, which is very good. And if we do the same thing using the free cash flow method, that's the only thing that I've changed here, the free cash flow inputs rather than EBITDA, discounting it back at the weighted average cost of capital for the company, we're getting a very healthy 23.3%. So we're comfortably going to beat the market in almost any scenario that I can think of. I think we're going to get some turbulence in the market. The company is currently at 2.4% of assets, under management. I don't. If the company were to dip lower and get around that $166, which would be a bit of an unlikely scenario, I would add in more, taking the position to maybe 3% of the portfolio. But for now, I think we're fully allocated into that particular sector, so it's a hold for me. Qualitatively, it's a great business. So low debt, margin of safety, sales growth, for the size of the company is perfectly acceptable, and I expect it to increase rather than decrease over the next 10 years. They're in a good position to gain a lot of government contracts. The US Navy is not as strong as it needs to be, and so there's a lot of work that needs to be done for the maritime prowess of the US to remain. And so as long as they can hold the strong margins which they have and free cash flow growth, we may see the company either grow via acquisition, or they may just start to buy back shares and increase our ownership of the future cash flows, which is a great scenario. Once again, if you haven't liked and subscribed, I'd greatly appreciate you doing that. And if you want to check out the portfolio, jump over to eToro on the link there, and you can have a look on their platform. Great platform. You'll find it easy to use. And as always, the disclaimer, I'm not your financial advisor, and it's only sensible that you do your own due diligence, okay? You're responsible for that, not anyone else. And on that note, I wish you all the best with your investing, and I'll be back with another video in another day or two.